Could I have your attention so we can get started? Welcome to everybody to the Peterson Institute for International Economics today for our semi-annual global economic forecast. This is the 14th in the series, obviously started 7 years ago, at which we try twice a year to systematically update our rolling forecast of where the world economy will be headed over the next couple of years and try to share it with our friends as in the audience today. We always take pride here at the Institute, as many of you know, on our exquisite timing of events. I would suggest that today is probably a particularly interesting day to be talking about the outlook for the world economy, even though there are a few key variables that are uncertain, just down the street, in fact, as we talk. We'll nevertheless be factoring some of those elements into the discussion. We've got some people here that are much involved in that side of the economic outlook, and we'll draw on them in the conversation after the initial presentations. The strategy that we selected for today was to have our usual three-part presentation. The first part will be a global economic outlook from Mike Mussa. The second part will be to look in a little more depth at the key emerging market economies, since they are now clearly the main drivers of world economic growth. And a key question is whether and to what extent they can continue to do that, i.e. how much will they be sideswiped by the current events, the financial turmoil, high energy prices, and other things. And so can their continued impetus, which has been so much in evidence in recent years, continue, and at what pace? And then third, as a special treat, we've invited one of our very good friends from outside the Institute, Dan Yergin, to talk about the energy price outlook, since that is so critical for the real economy. There have obviously been huge gyrations, up, down, back up. Where is that going, and what is that going to mean for the world economy as a whole? Our leadoff speaker, as usual, will be Michael Mussa. He was economic counselor and director of the research department at the IMF for 10 years, from 1991 until 2001, since when he has been here at the Institute. Prior to that, he was a member of President Reagan's Council of Economic Advisors in the White House for 2 years. His previous experience was as an academic, teaching at the business school at the University of Chicago and at the Department of Economics at the University of Rochester. Mike has, of course, published widely on a whole range of finance, macro, and international economic topics. I'm delighted today to be able to announce that at the forthcoming meeting of the National Association of Business Economists in a couple of weeks' time, Mike will be presented with their annual Adam Smith Award. It's one of the most prestigious awards given to any American economist. It's previously been awarded to Milton Friedman, Jim Tobin, Gary Becker, Douglas North, George Stigler, a number of Nobel Prize winners, and others. And we here at the Institute take particular pride that Mike Mussa is this year's winner of their Adam Smith Award. Mike will be followed by Arvind Subramanian, who's been a senior fellow here now for about a year and a half, holding a joint appointment also with our sister, the Center for Global Development, and also as senior research professor at Johns Hopkins, just down the street. So Arvind's a triple threat. He came to us after 15 years at the International Monetary Fund, where he worked on a wide variety of issues, and most recently as assistant director in the research department. He had previously worked at the GATT in Geneva on the Uruguay round, taught at the Kennedy School at Harvard, and has published very widely. Particularly those of you who read the Indian press will probably see him every week with an op-ed on one or another phase of Indian and global economic events, but he is also very widely published in the FT, Wall Street Journal, other publications, and a major book on India that he recently released since he has been here and left the IMF. Then finally, but by no means least, Dan Yergin, who's a member of our advisory board, but I think, is the first person to have the distinction of speaking on our global forecast panel without being a member of the staff of the Institute. Dan is, of course, one of the world's leading authorities on energy economics, international politics, and the broader world economy. He is the chairman of Cambridge Energy Research Associates, which is one of the world's leading research firms in its field, and he's executive vice president of IHS, which is the parent company of Cambridge Energy Research. Dan won the Pulitzer Prize for his famous book, The Prize, The Epic Quest for Oil, Money, and Power. It was a #1 bestseller. It was made into an 8-hour PBS BBC series seen by 20 million people. It's been translated into 12 languages. Dan's second book, Commanding Heights, The Battle for the World Economy, has been translated into 13 languages. Dan led the team that turned it into a 6-hour PBS BBC documentary, the major PBS television series to date on globalization. It received 3 Emmy nominations and won the New York Festival's Gold World Medal for Best Documentary. And Dan's writing a new book on the challenges of energy and geopolitics. His sales are not quite up to Tom Friedman's, but he's pretty close, #2, and is trying even harder with this third one. Dan has been given so many awards I can't even begin to mention them. The United States Energy Award for lifelong achievements in energy and the promotion of international understanding. And particularly relevant to today's presentation, he did testimony to the Joint Economic Committee on June 25th, 3 months ago, when the oil price was soaring toward its all-time record high of almost $150 per barrel. And Dan on June 25th said to the Joint Economic Committee, "I think we're near the peak and that the oil price may turn around and start coming down." Well, right on cue, 10 days later, it did. And it came down 1/3 since that time. So at least, as of now, Dan looks like the most prescient prognosticator of oil prices in the world, and we're looking to him to tell us from now where they're going to go. So, Mike, Arvind, and Dan, and then we'll open it up to the floor as a whole.
Well, thank you, Fred. It's a pleasure to be here once again. Fred noted in his introductory remarks that these are interesting times, recalling the ancient Chinese curse, "May you live in interesting times," no doubt invoked by the Chinese officials on Secretary of the Treasury Paulson during his last visit. Certainly, these are interesting times, and they are not yet over. In my remarks this afternoon, I will first overview the global economic forecast. The second, make brief remarks on selected emerging market countries, leaving to Arvind the task of dealing more in depth with the larger emerging market countries. The third, discuss developments and prospects in the other industrial countries. Fourth, focus on the U.S. economic forecast, baseline, and risk. And fifth, return to the economic implications of the ongoing financial crisis. The global economic forecast. Well, as anticipated in April, we have seen a significant slowing of the growth rate in the world economy from almost 5%, and I think we'll hit virtually on the dot the 3.8% forecast of April. Actually, the global economy is weaker than suggested by that forecast, but the quarterly pattern has not quite caught up with that. We saw reasonably strong growth still in a number of countries late last year and in the first quarter of this year. Things have slowed very dramatically in many countries around the world since the first quarter, and we had a number of important economies turn in negative GDP growth on a quarterly basis in the second quarter. And one of the consequences of this, which is not seen in the forecast for this year, is that the forecast for 2009 which previously foresaw a rebound to 4% GDP growth for around the world on a WEO basis, now sees global growth falling to 3.4%. Now, I put the borderline of global recession at real GDP growth of around 2.5%, so we'll still be well above that on a year-over-year basis. However, if we consider growth on this quarter versus 4 quarters ago, which is another way of reporting it, then by the first quarter or second quarter of next year, I expect the global growth rate on that basis to be down to 3% and possibly below. So we're getting close to the range which might be considered a global recession. Meanwhile, world inflation, which peaked at 6% on a comprehensive consumer price index for the world compiled by the IMF early this year, has begun to move downward under the impact of sharply declining world commodity prices. With evidence of the slowdown in global growth being, I think, the main factor behind the downturn in commodity prices. And I hope to learn more from Dan on his assessment of what's been going on in the oil market. So I'll not discuss that issue further on the principle that why go after the monkey when you can get the organ grinder. As the inflation rate has come down, and as growth has also slowed, policy priorities have begun to shift. I said early this year that in my judgment, surging world inflation was more of a policy concern than slowing global growth. Indeed, slowing global growth was going to be a necessary part of the answer to avoid a large and sustained upsurge in global inflation. Now that we've seen evidence that global growth is slowing and that world inflation appears to have peaked, the policy priorities are more evenly balanced. Inflation is still high and a concern and needs to be taken seriously in virtually all countries, with considerable variations across countries. But there is also the concern that while a slowdown in growth is necessary to contain inflation, that slowdown can become too big and can go on too long. And policy will need to balance now more carefully those two risks. So what we're looking at, in my judgment, for the world economy is actually a period of mild global stagflation. Slow growth but not recession. Inflation still a little bit uncomfortably high, but not moving upward at the present time. This is basically the situation in emerging market countries as well as in developing countries. Growth this year in emerging market countries is slowing significantly, about a percentage point from what it was in 2007 and in preceding years. And the 6.4% forecast in April, again, looks to be approximately right for this year, recognizing that things are slowing considerably over the course of the year, implying that a reasonable growth forecast for next year for the emerging market countries as a group should be below 6%. And we haven't been below 6% for that group of economies since 2002, as we were coming out of the mild global recession of 2001. The number I've put down is 5.7, so it's not a lot below 6%, but it is somewhat below 6%. And that reflects an assessment that growth is likely to slow down in virtually all emerging market countries, some more than others. I would note again that there are a few emerging market countries, particularly in Asia, Hong Kong, Singapore, Taiwan, where we've actually seen negative growth in the second quarter. The other thing I want to mention about emerging market countries is that after 4 or 5 years, when the IMF list of countries that might potentially become customers for IMF lending was pretty short, the prospects for doing more business in that dimension are going up. And presently on my list are the two Baltic countries, Estonia and Latvia, which have very highly appreciated real exchange rates, large current account deficits financed by spectacular capital inflows, and they could be vulnerable to a slowdown in those inflows. Romania and Bulgaria, which have big and growing current account deficits. Hungary used to be on that list, but I've moved them to the B list. Things have improved there a bit. But Turkey, I think, has to be moved up, if not completely to the A list, at least the A minus list. Pakistan also looks like it's going to be in considerable trouble as a result of the political turmoil as much as any economic developments. Ecuador is almost a perennial candidate for difficulty. Bolivia looks to be well on its way. If global commodity prices crashed, which is not my expectation given my forecast for the global economy, but if global commodity prices crashed, then the list of emerging market countries potentially in difficulty would grow by probably a dozen or so. Turning to the other industrial countries, growth was still strong either late last year or early this year in most of them, but slowed dramatically in the second quarter for many of these countries. Germany, France, and Italy and Japan all turned in negative growth in the second quarter. And while to some extent that was payback for the stronger growth earlier, the economic indicators suggest that things are going to continue to be relatively sluggish in most of those economies going forward. Accordingly, in the other industrial countries, for this year, the growth forecast has been cut by a couple of tenths, and for next year, the growth forecast is barely over 1% for the other industrial countries as a group. Meanwhile, while inflation and rising inflation has been the key policy concern in most of Europe and in Australia over the past year or so, the slowdown in growth and the moderation of inflation is changing that situation. And I don't think we will see further monetary tightening by the ECB or others. The UK has already started to ease, the Canadians have started to ease, and we may see the European Central Bank begin to ease late this year or early next year, depending on how pronounced the slowdown proves to be. But it's important to recognize that margins of slack are much smaller in most of these economies, if indeed they are positive, than they are in the United States. The unemployment in the euro area has barely ticked up and remains today half a percentage point below where it was at the minimum during the last economic expansion. So the ECB, I don't think, will feel any great urgency in the path of monetary easing, and rightly so. As far as the U.S. is concerned, my forecast in April was for 1.2% year-over-year growth, and I think that actually has to be kicked up a tenth or two because we got a particularly strong second quarter. And I boosted the forecast to 1.5. That actually envisions that the last 2 quarters of the year will have slightly negative GDP growth. The forecast for next year is year-over-year 1.3. That envisions a very weak first quarter and then an acceleration to about the potential growth rate of the U.S. economy, 2.7%, in the second half of the year. Obviously, there are significant risks around that baseline forecast. If we look at those risks by examining the 4 main components of GDP, then it's reasonable to expect that consumption spending will grow very sluggishly. We may get a quarter or two where it actually declines outright. But even in steep recessions in the past, it has rarely been the case that consumption has dropped on a year-over-year basis. In terms of investment, business investment in structures has probably peaked and will start to weaken. And in equipment and software, I expect also, where it's been relatively flat, may weaken some over the next couple of quarters. But not a great deal, because we don't have a great deal of excess capacity. Capacity utilization rates, while down from 83% to a little below 80, are not extremely low at this stage. In residential investment, we've already seen new home building decline 60%. And I think we're probably near the bottom. It is a very deep bottom. But with housing prices having corrected dramatically, by the end of this year, I expect that on basis of the Case-Shiller index, adjusted by the CPI, real house values will have fallen by a third from their peak in 2006. That we're getting near the point where it's reasonable for people to think, well, they're not likely to fall a great deal further. And provided we can rejuvenate to some extent the mortgage market, then a gradual recovery of residential investment from extremely depressed levels is a reasonable prospect, beginning at least by the second half of next year. The other component of business investment that is a key cyclical mover is inventory investment. That was minus $50 billion at an annual rate in the second quarter. It should stabilize around plus 40, and my expectation is we'll be up there by the end of next year. So there's a considerable bounce back in inventory investment, which will help propel total business investment to a positive contribution to GDP growth. Government spending will keep advancing at a modest pace. Net exports have been essentially totally responsible for U.S. GDP growth over the past a year or so, with domestic demand growth being very weak. I think we won't get quite so much because export markets for the U.S. are growing more slowly, and some of the effects of the earlier depreciation of the dollar are probably beginning to wear thin. Still, half a percentage point contribution to GDP from further improvement in net exports. Now, if you add that all up, you get more than my baseline growth forecast. And that's for two reasons. One, I need to make some allowance for the negative effects of the financial crisis. So adding up the components does not produce for me a forecast that is reasonably evenly balanced for upside and downside risks. Second, I think the GDP numbers that have been reported recently are significantly biased to the upside, and when they're revised over the course of coming months, particularly next July, we'll find out that growth and GDP have been lower than we now think, and it's necessary to take some account of it. So the prospect for the U.S. economy is, as a baseline, we are right on the edge or slightly over the edge of recession. I would say it is a recession, or certainly will be a recession, because the unemployment rate, which was 4.4% in the summer of 2006, is already 6.1 and is headed up to 6.5 or higher. In all of the past 10 occasions in the post-war period where the unemployment rate has risen 1.5% or more, that has been associated with a recession. And I think we should probably call it a recession this time, even if it's difficult to date the precise starting point and the precise ending point, which is what the National Bureau of Economic Research attempts to do. That's the baseline forecast. There are clearly risks about it. One of the key risks is the ongoing financial crisis. What can we say about its likely economic effects? First, so far, they have been small, despite many forecasts in early 2007 that we were 80 or 90% likely to have a recession that year, and forecast early this year from some that a recession was almost certain. Through the second quarter, it hasn't quite started yet. So the economy has performed really quite well in the face of the greatest financial crisis in the U.S. since the Great Depression, according to some statements. Now, there is a negative effect. Undoubtedly, the downturn in housing is longer and deeper than would have been the case without the financial market, additional impetus from the financial market turmoil. And businesses and consumers are beginning to feel some broader negative effects from the financial turmoil, in addition to the downturn in the financial sector itself. It's noteworthy, however, that as of the August employment report, the decline of employment in finance, insurance, and real estate, which was 8.3 million at the end of 2006, is only 200,000. Now, I think there's more to come, but it hasn't come yet, at least not according to the Bureau of Labor Statistics. So far, the impact has been small. It will get larger as we move through time, even if we get past the current difficulties in financial markets. The worry is that the present situation in financial markets is really not sustainable. What we saw 8 days ago was the short-term money markets and credit markets freeze up. The spreads in those markets escalated 300 basis points, 400 basis points above Treasury yields as Treasury yields were pushed down. And those were kind of shadow yields. Many transactions were simply not occurring. Well, the functioning of the U.S. economy requires that businesses be able to roll over their maturing short-term debt. If they can't do that, then, as I describe it, it's like going into ventricular fibrillation. The heart is no longer pumping blood and oxygen around the body. Within seconds, you're unconscious. Within 3 minutes, you're suffering permanent brain damage. Within 5 minutes, you're brain dead. And within 10 minutes, you're totally dead. Now, the economy doesn't quite work that way, but if the mechanism for circulating short-term credit is not restored to reasonably effective functioning, the damage that the economy will begin to suffer within a matter of weeks, if not days, is going to become quite substantial. So that problem needs to be fixed. And probably they need to make the major part of the fix at least over the weekend or early next week. Assuming it is fixed so that the short-term credit markets resume more or less normal functioning, then I think that by the middle of next year, the financial crisis will probably subtract about 1% from the level of GDP, and that foregone output between 2008 and 2010 will accumulate to 2.5% to 3% of GDP, which is $300 billion plus or minus lost output, and that's not a trivial amount. It is not, however, the Great Depression. Now, I want to make one further comment. Is this really the greatest financial crisis since the Great Depression? And I think the answer to that question is definitely not. The mid-1970s and the early 1980s were clearly worse. Only we hid it. How did we hide it? Well, we allowed financial institutions to keep their books at historical cost. Or if that didn't work, we instituted regulatory accounting principles, which were even more liberal than GAAP, that kept savings and loans from having to recognize their dire situation. The fact is that at the end of 1981, every major bank in the United States was on a mark-to-market basis, that is, under our present accounting standards, insolvent, and significantly so. And the savings and loan industry as a whole was not simply insolvent. It had negative equity of 20% of its total assets. But we hid it by the accounting standards and really didn't face up to the savings and loan component of it until the late 1980s. On this occasion, mark-to-market accounting is forcing much more timely recognition of losses. Indeed, I think it's actually exaggerating to a significant extent the losses that are likely to be there if we could calm the situation down. That is not in all respects bad, because in contrast to what happened in previous episodes, major financial firms have been forced to go out in the market and raise additional capital, diluting the position of their existing shareholders. A cost is being paid. Is there a bailout? Absolutely. But in the past, the bailout often used to come almost entirely under the table because the Federal Reserve would cut interest rates and keep them low, which would reduce the income that all of us earned on our assets, reduce the cost of funds to the banks and others, and fill up their balance sheets again at our expense under the table. Well, this time they're being forced at a much earlier stage to actually recognize the losses that were taken by their poor investment decisions previously. And that's not a bad thing. I think it's also not a bad thing that the American people seem to be really pissed off at the prospect of getting a big bill to clean up this mess. That will provide the impetus for much more serious consideration of reforms going forward. Moral hazard is undoubtedly being created in the episode of this bailout, but I think actually less so than in previous episodes where we did not face up to the problems at an early stage. And if you think we were bad, you can consider what the Japanese did in concealing their financial problems for 6 years during the 1990s. So, in conclusion, we are in the midst of a period of stagflation, inflation still uncomfortably high, but probably coming down, growth slowing, the U.S. economy probably in recession, or soon so on any reasonable definition. But I don't think we are yet looking at a steep recession on the order of what we saw in the 1970s and 1980s.
Thanks all very much for coming today. And I'm told that Voltaire, as he was dying, called his priest and his lawyer, stood them on both sides and said, "Now I die like Jesus with a thief on my left and a thief on my right." And I feel a little bit like that, but sandwiched between Mike and Dan, except it's the other way around. I feel like an interloper with Jesus before me and Jesus after me. So I'm going to be very brief and speak about the prospects for the emerging markets, or as we like to call them, the big emerging markets, the trillion-dollar club countries, of course, in the context of what is going on in the US and worldwide, in the context of the ongoing financial crisis. Turning quickly to Mike's central scenario, emerging market growth comes down from 7.4 to 6.4 to about close to 6. And while this reduction is not insignificant, thus far the impacts on major emerging markets, including China, India, Brazil, Russia, are, on his estimate, relatively modest. And I think it's some combination of limited financial contagion, so far again, and a greater ability to contain financial contagion, because, unlike in the past, some countries are running current account surpluses, they have very, very high level of reserves, and relatively moderate external debt. And it is noteworthy and somewhat reassuring that China, which is the biggest emerging market country, seems relatively invulnerable to financial contagion. And this, Nick made a presentation 2 weeks ago touching on some of these issues. Second point, trade contagion so far also seems to be limited, because the industrial countries' slowdown, while substantial, is not yet serious and not quite a full-blown recession. So in the central scenario, what I take away from Mike's thing is that, by and large, this is going to be, relatively muted, not all hell breaking loose. If you look at some of the indicators of emerging market risk, for example, again, compared to previous episodes, so far at least it's been relatively muted. Risk indicators have gone up for Brazil, much more for Russia, and relatively little for China. And the spreads are about 300, 350, which is not very high by previous episodes of crises. Again, on the exchange rate, you find China relatively unaffected. India and Korea started, their exchange rate started declining earlier, in some sense predating the current turmoil, partly because of inflation concerns, commodity price increases, and the fact that there were these oil price increases significantly affected their current accounts. And only recently, in the recent episode, Brazil and Russia have been affected, but again, as yet, not that much. So contagion at this stage seems to be, wouldn't say contained, but not yet flashing amber signals. But what I want to focus on in the rest of my brief presentation is to talk about the risks, which I believe are nearly all on the downside. Mike has mentioned that some countries remain very vulnerable to financial contagion, and he mentioned the large current account deficit countries, Bulgaria, Romania, the Baltics. One could add South Africa. And of course, if commodity prices head south, the commodity exporters like Russia, Venezuela, Ecuador will remain vulnerable. So these risks remain, and in some ways, these are the kind of conventionally countries that are vulnerable to financial contagion in the conventional sense. But there is, I think, another vulnerability which I think needs to be emphasized much more, which is that healthy net positions and sound sovereign balance sheets do not necessarily provide insulation. A couple of good examples here are, Russia and many of the East Asian countries, where even as we speak now, liquidity conditions are tightening. And I'm told, for example, the loan syndicate market in vast parts of East Asia have again frozen up. I think the important point here is that when you have skittish markets with significant rollover risk, significant gross financing flows, these become very important, and rolling them over is not automatic, creating significant risks. For example, Russia has a rollover requirement by its corporates of about $50 billion this year. The Russian banking system is exposed to contagion. It's heavily exposed in the real estate sector. So I think there is a significant vulnerability here. But it applies to large parts of East Asia as well, where foreign corporates have borrowed abroad and face significantly tightening liquidity conditions. Spreads have gone up, interbank rates are going up. And it's just because their sovereigns are vulnerable is not going to make it automatic for them to switch their financing from foreign sources to domestic sources. So in many of these countries, risks to slower private investment remain substantial. And so I think the key point here is that one has to also focus on gross flows, gross financing requirements, and not extrapolate from the fact that sovereign balance sheets might be necessarily sound, and therefore things are okay. The second point about the risks, of course, is that regardless of what happens today in Washington, I mean, the one thing is the probability of the what I call the Bernanke plan, but it's more the uncertainty about what effect it might have, even were it to be ratified soon by Congress. Because, I mean, if, for example, it doesn't have the effect that it's meant to, the financial crisis could deepen, and if there is, a full-blown recession in the US or EU, then I think via the trade route, many emerging markets become vulnerable, and even a country like China that was relatively invulnerable on the financial side faces a real risk of slowing exports and therefore growth. I think, moreover, I think we have to recognize that we're in a world of real uncertainty. These processes are not smooth or linear, and an external shock, as we found out in the East Asian crisis, could simply be a trigger where they interact with other vulnerabilities. For example, Nick mentioned the other day that the real estate investment in China is softening, which is a potential source of slowing demand and slowing growth. And so it's easy for an external shock to interact with any one of these inherent pre-existing vulnerabilities, for there to be multiplier effects and kind of discontinuous jumps. So these kinds of outcomes cannot be ruled out as yet. The other important point to note as far as emerging markets go is that in the event of things taking a bad turn, the space that they have to rebalance growth toward domestic demand is limited, because inflation remains quite high, substantially high, and well above policymakers' tolerance levels, comfort levels. In Brazil, it's above 6%, Russia 15%, India 12%, and Korea again 6%. These are very high. So the room for monetary policy to cushion any softening of external demand remains limited, which represents, I think, again, a risk to the downside. Of course, there is some fiscal space in some countries, especially China, but again, with fiscal injection, we're always uncertain about how feasible they are and how quickly they can take effect. I think the bottom line for me is that there are not inconsiderable risks of significant slowdown in emerging markets, with the big uncertainty being about the bailout plan and what impact it may have should it be passed in the next few days. So a second corollary is that whatever predictions we may make now about emerging markets and so on, just the extent of uncertainty means that our confidence bands around these predictions have to be much wider. I want to conclude with two. I want to throw out two kind of thoughts or ideas. I mean, one can say many things about what's going on in this crisis in terms of their impact on emerging markets, but I like to think of this, in two ways. I think two things come to mind. One, when you step back and look at what's happening, one can think of it as two related processes being underway now. On the one hand, there is a rebalancing of demand, of global demand going on. At the same time, there's a global repricing of risk that's taking place. So these two processes are underway. And the question is not whether it's going to be orderly or disorderly. The question is going to be whether it's minimally disorderly or maximally disorderly. I think that's the range in which we're operating. And it seems to me that both of these processes invariably signify a negative impact on emerging markets and slowing growth. Repricing of risk necessarily entails higher cost of capital. Investment is going to be affected, and that's going to, in the short to medium run, slow down activity as well. On the rebalancing of global demand, I mean, we see now U.S. current account deficits improving. The question is, where is the offsetting impact going to be? Most Asian currencies are actually depreciating, as we know. So where is the give going to be in the system? That's kind of an open question, which is going to speak to how this process is going to unfold. The second thought that comes to my mind from a policy sense is that I think what the current episode makes clear is that finance is global, but regulation is still largely national. And there's this inherent tension that's, I think, coming to the fore increasingly, which will have to be addressed in the near future in terms of greater multilateral cooperation. One can think of it in two ways in the current crisis. In terms of the causes, we know that the savings glut and undervalued exchange rates were a part of this problem in terms of the origin of the problem. And the Peterson Institute has been in the forefront about arguing about the need to get some multilateral surveillance over exchange rates. And I think this episode is going to increase or should increase the urgency of those efforts. A second, in terms of solutions, we know that this is going to become more important in the days ahead. Burden sharing on the downside. There is the whole UBS problem, whether foreign institutions are going to be covered by whatever plan now is going to be put out. In Europe, for example, a Belgian bank has big exposure in the United Kingdom. It's not obvious that regulatory mechanisms are in place to sort these things out in an orderly and smooth way. So how are we going to get burden sharing on the downside more generally in this episode and future episodes, I think is a question that I think needs much greater attention. So thank you very much.